Welcome to Escape Velocity, a podcast to unpack the 0 to 1 journey of founders who have built successful, scaled businesses today that we all admire. In this episode, we take a break from interviewing founders and speak with Lina Khan, Chair of the Federal Trade Commission. In this role, Chair Khan is tasked with enforcing the nation's antitrust and consumer protection laws, including in big tech and artificial intelligence. When she was sworn in 2021, Chair Khan became the youngest person ever to hold this role. Chair Khan, thank you for joining us today.
Thanks so much for having me.
Let's jump right into it. We often describe a startup finding product market fit as finding lightning in a bottle. In some ways, your famous paper at Yale Law School on Amazon was a major inflection point for your own career. What do you think struck a chord with people in that analysis?
So that paper actually grew out of, a year plus project for me where I had spent a lot of time talking to businesses and talking to investors about how they understood Amazon. So this is, over a decade ago, around 2012, 2013, where, people were still trying to figure out what was really going on with Amazon. Here you had a company that was delivering enormous growth, and yet its financials looked a little bit different. And so it was through those conversations with investors and with businesses that I got some insight into how these market participants viewed Amazon as actually amassing structural power. And it was through contrasting that business understanding of Amazon with how the laws understood Amazon and viewed its business practices that I think exposed a interesting tension and an interesting gap between, theory and what was really happening in reality. And actually, once my paper came out, a lot of the people who I initially started hearing from was actually lawyers at businesses, some of which were Fortune 500 companies. And they said things like, this is exactly how we experience this company. And you're absolutely right that there seems to be a gap with the law. So I think it was that kind of business understanding of the company that ended up striking a chord.
The stock market has hit record highs this year, powered primarily by big tech companies. The biggest tech companies are only getting bigger. Is that a problem in your view?
So we enforce the nation's antitrust laws and consumer protection laws. And those laws are really focused on our companies illegally growing. It's not about growth, good or bad. It's really about the business tactics and business practices that are being used. And so, you can think about it as a referee in a game, and it's really about policing the rules of fair competition. And so, in the same way that we wouldn't think it was fair competition to go kind of burn down the factory of your rival, there are all sorts of ways that antitrust laws recognizes that there are some practices that are fair game and fair ways to be growing, and that there are some practices that are just underhanded and are unfair methods of competing. And so that's really the line that we police. And look, America's economic growth and the way that we've been able to stay ahead globally through phenomenal innovations in Silicon Valley and other places have been a result of our being so committed to open, fair, competitive markets, to wanting to make sure that the best ideas win. And if you have a good idea and if that idea has resonance in the market, that you're actually able to compete fairly, compete on the merits of your idea rather than being blocked out because your idea is threatening to one of the existing big guys. And so, in a lot of ways, what the FTC stands for and the work that we do is perfectly aligned with creating open, healthy markets where startups and founders should be able to thrive.
The FTC's posture has seemed to cause a deterrence in the marketplace with regards to acquisitions. And although that may help in theory with limiting monopolistic activity, the reality in the startup ecosystem is that acquisitions also fuel innovation. They provide opportunity for entrepreneurs and their employees who would now have the financial footing to start their next big company. It provides liquidity to investors, not just VCs, but their LPs who support the innovation economy. Do you worry about the downstream impacts of a slower M&A environment in the technology ecosystem? Are we accidentally hurting the innovators that the policy is trying to protect?
Yeah, it's a good question. And I'm glad you asked it because I think sometimes there can be a little bit of misunderstanding here. So, just to set the scene, we get anywhere from 1,500 to 3,000 deals reported in any given year, and a pretty small fraction of those even get a second look. Around 2% of all deals are even investigated closely, and an even smaller percentage ultimately are challenged and litigated. So 97, 98% of deals are really still going through without a lot of second questions being asked, the vast majority of which are not posing legal problems under the antitrust laws. The laws are designed to prevent acquisitions that we think may substantially lessen competition or tend to create a monopoly. What does that mean in practice? Oftentimes it will mean, mergers between direct rivals who are head to head competing. Sometimes it will mean mergers between companies that are in different parts of the supply chain. And so, for example, early in my tenure, the FTC sued to block NVIDIA's attempted acquisition of ARM because we thought that that would deprive other firms of really important next generation technology that was going to be critical for innovation. We also blocked Lockheed's attempted acquisition of Aerojet because we believe that similarly would deprive other market participants of access to key technologies. And one of the third categories is instances where we think an existing incumbent is making an acquisition that will deprive the market of a key upstart or a key firm that is injecting much needed competition. And so, just to give you a concrete example here, last year the FTC sued to block Sanofi's attempted acquisition of Maze over a drug that is needed to for patients who suffer from Pompe disease. It's a rare disease, but really debilitating. These medicines currently cost hundreds of thousands of dollars, and under Sanofi's medicines, you have to basically go get IVs twice a week. Maze has been this upstart that is innovating and creating a drug for Pompe disease that patients would be able to take orally. And so it could be an enormously important innovation in the marketplace, deliver lots of great benefits to these patients. And when Sanofi tried to buy them up, our concern was that there was going to be a potential cannibalization problem, right? So Sanofi is currently earning great returns on its incumbent drug. And there was a risk that if it bought up this upstart, it wouldn't want that cannibalization. And so wouldn't be best invested in ensuring that that drug, that innovative drug, would actually get to market quickly and succeed. And so we blocked that deal for that reason. Ultimately, what ended up happening was Maze ended up partnering with another firm. And that acquisition, that partnership went through. And so that's really what we're focused on: is an acquisition going to undermine competition and undermine innovation, because the incentives of the buyer might not actually be lined up with getting that innovative product to the market.
So, in that context, do you think that the private sector may have over rotated on the FTC's posture in terms of their potential fear of FTC action in M&A?
It's difficult for me to say. I think if you look at the numbers in terms of, we are certainly more active, and I think, focused on deals that primarily in the past probably would not have gotten a second look. But the reason we are doing that is because there's broader recognition that in the past we missed things. Before I joined the FTC, the agency sued to undo Facebook's acquisitions of Instagram and WhatsApp, in part based on evidence that Facebook at the time felt threatened by these upstarts because it wasn't itself able to organically make the leap from desktop to mobile, and ended up buying up Instagram and WhatsApp as a way to, ensure its dominance even in the mobile sector, and because it felt threatened by these firms. And so, those are examples of missed opportunities. There are other cases that are currently pending that similarly recognize that certain acquisitions in the past were designed to undermine competition and the agencies missed them. And so we're trying to learn from those experiences. Candidly, as a law enforcer, you want companies and you want lawyers to be thinking about the legal ramifications of a deal early. It's not a good use of public taxpayer resources to be going after deals that are flagrantly illegal and really probably should not have made it out. And so, from the perspective of risk mitigation and making sure that those legal risks are being thought of on the front end, that's a good thing. But we're absolutely happy to do a lot of engagement and explain to the startup ecosystem, generally speaking, what are the types of deals that might trigger that scrutiny and what are the types of deals that won't. And look, they're going to be a lot of instances, I think, in which the interests of the startups and the founders are going to align with making sure the antitrust laws are vigorously enforced. Because even if ultimately you do want an exit through an acquisition, a world and a market in which you have five or six or seven or eight potential suitors is going to be a better world than a market in which you just have one or two, right? In terms of the bargaining leverage you're going to have, in terms of the valuation that you're going to be able to get, in terms of the ability to get better, contractual terms. And so having a more competitive ecosystem, we think is going to be good for those startups as well.
The FTC has stated they are looking at a variety of companies in the AI space, including Microsoft's partnership with OpenAI. How do you think about balancing the fact that advancements in AI, specifically in foundational models, require high capex, and there are few companies that can finance these critical advancements for the rest of the innovation ecosystem? Are there some economies of scale necessary in the private sector that are a net benefit for the rest of the economy?
Yeah, it's a very good question, a very relevant one right now. In some ways, it's not an altogether new question, right? I mean, going all the way back to the railroads, we saw how there could be sectors where there were enormous economies of scale and kind of infrastructure that was critical for all sorts of downstream business activity. And, we came up with rules to make sure that those railroads couldn't abuse their power so that the rest of the economy could benefit. I think what's also interesting right now is that traditionally these moments of technological breakthroughs have come from the upstarts, from the outsiders that have come up with a disruptive idea, and it's often, disintermediated or bypassed the existing incumbents. What's really interesting about how AI is developing right now is that the raw materials and critical inputs to some of these technologies are currently owned by some of the existing incumbents. And so, what that moment of disruption or competition is really going to look like is interesting when some of the key technologies and key inputs are owned by the incumbents. And so, we want to make sure, a lot of these technological inflection points end up being so important for our economy, right? I mean, you see so many key innovations, so much growth that's being catalyzed. And we just want to make sure that that opportunity is not being foreclosed or co opted or distorted because of the incentives of the incumbents, and in instances in which the incentives of the incumbents may misalign with what's good for the broader market or the public as a whole. And so that's how we're scrutinizing it. Antitrust and competition are just one set of tools. In the context of the railroads, we ultimately ended up having separate rules to make sure that the railroads couldn't, pick winners and losers in the marketplace. And so you didn't have certain, coal companies that couldn't get their coal on the railroads because the railroads were preferencing their own coal. And so we had, a whole set of rules designed to prevent that discrimination and exclusion, and it's possible we'll need something like that again here if we think that competition itself is not going to be enough to discipline potential abuse of market power. And so it's really about making sure that there aren't unnecessary choke points or bottlenecks in the market that are impeding the ability of founders and startups to get a fair shot.
Many nation states, from China to the UAE, have made it a priority to invest directly into their sovereign AI efforts. We have a long history of private markets in the US funding innovation. But which is worse in your view? Government funding, which could result in kingmaking and negative market dynamics, or a deep pocketed private financier who may end up with more market influence? And if both are not ideal, paint us a picture of what the third option looks like.
It's an interesting question because actually in antitrust and anti-monopoly, these things have traditionally been understood to be deeply connected. And the original kind of anti-monopoly sentiment in the US was actually a protest against the British East India Tea Company because, there was frustration that this one company had basically been given a de facto monopoly by the monarch. And so there was a recognition that in order to have fair competition, you needed to push back against special privileges being handed out by monarchs to particular companies. And so, look, I think we need to be very vigilant, especially at these moments of technological inflection points. I think there's absolutely an important role for public investment. And under the Biden administration, we see a lot of that, being directed in ways that's supposed to crowd in private investment rather than crowd it out. And so I think we need to make sure that when you have these, funds being handed out or these grants being handed out, you're doing so in a way that's mindful of the effects on market competition. And so that means you can attach certain strings. You can say, you need to make this technology interoperable. You need to make sure that you're open for business with everybody rather than just doing business with a handful of big guys. And so there are ways to attach rules and attach conditions to public funds and public investments in ways that make sure, this is boosting competition rather than distorting the market. I think we also need to be, really clear-eyed geopolitically. This is clearly a moment where, America is in a race with other nations here, and what we've learned in the United States is that we do best when we allow free enterprise and when we allow open competitive markets rather than picking national champions. And I think we've seen actually a lot of costs of the government picking national champions and that actually setting us behind. I think other countries that have in the past chosen national champions over competition have also gotten left behind. And so I think this is absolutely a moment where we need to redouble our commitment to open, fair competition.
AI seemed to catch many large tech players on their back foot. For example, ChatGPT challenging Google search capabilities, or Apple recently outsourcing its AI to OpenAI. Do you think these are examples of the fact that the pace of technological advancements in recent years has actually made the staying power of monopolistic companies much weaker?
It's interesting because it's hard to know what the counterfactual could have been, right? If we actually may have seen some of these technologies introduced even faster in certain alternative scenarios. But that said, there is actually a lot of research out there trying to understand what is the optimal market structure to promote innovation. And there's kind of this age old debate known as the Schumpeter arrow debate, where Schumpeter famously said it's actually monopolies that are best for innovation because monopolies can reinvest their monopoly profits into innovating and into R&D. Kenneth Arrow famously said, no, it's actually competition that's best designed to produce innovation because monopolists get lazy, they get comfortable, they get blind spots, and so really it's competition that you need to double down on. Really, the underlying question is what type of innovation are you trying to promote? And a lot of the research shows that if all you're focused on is some of this incremental innovation, then indeed some of the dominant incumbents can be pretty good at delivering that. But historically, the breakthrough innovations, the paradigm shifting innovations have traditionally come from the disruptors. And so I think that's why maintaining markets that are open to disruptors is going to be so critical. And I think the risk that we've seen in digital markets is actually that some of these markets can tip, right? Because of the network effects, because of the self reinforcing advantages of data. And some of these platforms in particular have all sorts of levers and mechanisms that they can use to deepen the moat and to make it so the moat becomes much more difficult to penetrate and cross. And so those are the dynamics that we're very aware of, that it can be sometimes harder to maintain competition in some of these digital markets because of how those dynamics work. And that just means we need to be vigilant early.
Many of the projected applications of AI require the use of larger data sets and proprietary data sets as it relates to certain industries, for example, healthcare. Have you and the FTC looked at this vertical by vertical? And for example, in a place like healthcare, where singular companies like Epic hold data in a seemingly walled garden, does the FTC have an interest in making better interoperability rules for data to unlock these AI gains?
We're certainly looking at a whole set of verticals, and healthcare generally is a big area of focus for the FTC, given how high the stakes are for ordinary, regular people about whether you can or can't afford healthcare, whether your health data is protected or not. So that's a big area of focus generally. You're absolutely right that these types of interoperability regimes can be a key mechanism to try to combat some of those network effects and some of those dynamics in digital markets that can lead markets to tip and make sure that actually you could still have some more competition. And so that's absolutely a tool that we look at. More generally, some of the concerns that we're hearing right now are about who's even getting access to these raw materials and these inputs, right? Who's getting access to compute and on what terms? Who's getting access to the models and on what terms? And to the extent that we're seeing some partnerships and strategic investments by some of the incumbents and some of these newer firms, what are the terms of that? And is that creating distortions in the marketplace, right? If you have a big cloud computing company doing a partnership with a model company or with one of the downstream apps, is that going to mean that competitors are not going to be able to get as good deal terms or as good access to those inputs? And so, those are generally some of the dynamics that we're looking at. We earlier this year launched an inquiry into some of those strategic investments and partnerships to look under the hood and make sure these deal terms are not hurting competition.
Where else do you worry about anti-competition in the AI space?
So we've heard concerns, candidly across each layer. We've heard concerns about some of the chips, and who's getting access on one terms, and whether there may be efforts to combine hardware and software in ways that could impede switching. We're hearing concerns in the cloud layer, similarly about potential exclusionary practices, about practices that can make it harder to switch. And then in the open models question more generally, we're hearing concern, including from creators whose work is being scraped, and there's a lot of opacity about do you even have the opportunity to say no if you don't want your life's work and all of this valuable creation to be scraped? And what are the terms of that, right? Can you get compensated? Is it an opt-in model or is it only opt-out? So we've been hearing a lot of concerns from those creators as well. But I would say on competition and the chips and the cloud more generally, I think it's again about bottlenecks and choke points and whether these choke points are potentially being exploited.
You mentioned in another interview that the economy has grown 15-fold since the 1980s, but the size of the FTC has remained basically the same. If there is one thing other than resources that you would change about the FTC, what would it be?
I mean, there are absolutely some areas where the FTC's authority can make it difficult to really make sure that the public is being protected. So, one limitation we have is sometimes it's really difficult for us to get money back for people when they've been defrauded. And so that means that, if you find somebody cheating in the marketplace, all we can sometimes do is stop the cheating rather than actually get money back for those that were cheated. And that can be a problem, right? Because if there's profit to be made from breaking the law, and at the end of the day, if you get caught, all you have to do is stop breaking the law, but you're not having to hand over your illegally obtained profits, that can just create a challenge when you're trying to crack down on fraud and those types of practices. So I would say some of those legal remedy issues are a big one for us.
You've made a large and impressive impact in your role already, whether people agree with your views or otherwise. You've taken a very clear stand. If we fast forward many years, what do you hope that your legacy as chair will be in Silicon Valley?
So, one big area of focus for me has been making sure that we have technologists in house to make sure we're fully understanding how these markets and how these technologies are even working. And so, it's been a big source of gratitude for me that we've been able to launch an Office of Technology in house. And that's really impacting our work in terms of how we do our investigations, how we bring our cases, how we craft remedies. I think there's a real technological sophistication and expertise there that we've been able to bring to bear because we have such great in house talent, data scientists, data engineers, AI experts. And so I hope that will continue. More generally, it's been a big area of focus for me to make sure we're hearing from market participants, that we're not just kind of cloistered in Washington, D.C., hearing from the big companies and lobbyists, that we're actually opening our doors and hearing from market participants across the board. Sometimes there can be an assumption that tech interests are all in one the same. But I think what we've seen is that, big tech interests can diverge from little tech interests or startup interests or founder interests. And so it's been really great to hear from that broader set of people. I was out in Silicon Valley a few months ago. We've kind of kept up those channels of communication. And so I would hope that one long term impact is going to be that we continue to keep our doors open to hear from market participants across the board, not just the big guys and the incumbents that can afford fancy lawyers in DC.
Thank you, Chair, for joining us today. It's been an absolute privilege to have you on our show, and I'm glad to see your continued interest in building an open dialogue with the tech ecosystem here in Silicon Valley.
Thanks so much. Great to chat with you.